Head of Research from Peters Australia Capital, joins us live now from the Sydney CBD studio. I guess, Nathan, the question to ask is, do you think when it comes to what we've seen from reporting season, Australian investors perhaps focus too much on dividends?
Yeah, I think the share price action at Telstra probably gives you a clue. The stock price has nearly halved over the past couple of years, and I absolutely understand why Australians love their dividends. About half of the total return throughout history in the Australian share market has come from dividends. We have an excellent imputation system so that shareholders don't pay twice on company profits. And it's just a really good market for earning good income, and particularly when interest rates are so pygmy-like at the moment, you can understand why people want the dividends, or particularly retirees, from their shares. But I think what happens is that often we focus so much on the dividend yield, we actually forget to think about what the future earnings are going to look like for a business. And with Telstra, it was very clear when it did the deal to basically sell its copper network to the NBN that the compensation payments, which I think were around $11 billion initially, the company wouldn't be able to support those high dividends forever. So it wasn't like that was a secret. It was very well known. And so in that sense, I don't think investors have anyone to blame for not knowing that those dividends would be cut at some point. And even with a big cut in the dividend, I note that about a third of next year's dividend is a special dividend, so you can't even count on that either. So I think investors need to be very careful about even looking at something like Telstra, which you think would be a very boring and stable telecommunications company. Even their profits can move around a lot, and you can see big cuts to the dividend.
With that in mind, what would you suggest that investors look to instead? Because my understanding actually is also you believe that price to earnings ratio, again, still not necessarily accurate.
Yeah, my view is that the price to earnings ratio is one of the most overused and abused financial metrics out there. It can give you a very quick snapshot, potentially, of the valuation of a company, but it's only a snapshot in time, and if you look at a discounted cash flow valuation for any business, about half of the value comes from the earnings 10 years plus, which is, if you compare that to the average holding period of a stock, which I think is now down to a few months, is quite remarkable. So you actually have to do the work to understand how a business is going to change over the next decade, and what sort of profits they're going to earn, and what sort of dividends they're going to be paid out. And I think a lot of people don't want to do that because it's hard work. And it also, I think, stops people from investing more overseas because we don't have that dividend imputation. Dividends tend to be very low, and particularly in the US, the companies tend to have more share buybacks than dividends. But I think Australians who have thought this way just really need to think a lot harder about where they're going to get their returns from, because we've had an absolute incredible period since 2009 where the big companies like the toll road companies have given you massive capital gains, and you've had huge dividends as well, and I think that is basically coming to an end now.
What do you encourage investors look to then when it does come to reporting season, and as you mentioned, that more solid future outlook?
Yeah, well, I think people should take the knowledge that they have in Australia and apply that to industries overseas is one way that I guess that we look at it. And in the telecommunications space, we don't actually own telecommunications companies in the US, but we own broadband providers, which tend to be wrapped up with pay TV companies. And we own them in America, we own them in Europe, we own them in Latin America. In Latin America, internet broadband rates are only about half what they are in the US or Australia, so there's a huge growth runway there. And the broadband providers tend to be almost monopolistic businesses, and they're just wonderful businesses because adding someone to the network basically costs the companies next to nothing, whereas if you've got a cable TV company and you've got to pay for content, you only get about 50% of that revenue. So we are benefiting from the big growth in mobile and broadband, and okay, so we don't get as big a dividends as what we get from Telstra, but we think we're going to get a much higher total return over time.
Nathan Bell, always great to have you with us this morning. Thank you.
Thanks, Natalie.